This is your brain on risk. This is Mind Over Money, the podcast where Kevin Cook exposes the psychology of investing.
Welcome back to Mind Over Money. I'm Kevin Cook, your field guide and storyteller for the fascinating arena of behavioral economics. If you are an active investor, you are no doubt familiar with the acronym FANG, which stands for a group of stock market darlings that have come to symbolize this bull market's new economy companies: Facebook, Amazon, Netflix, and Google. The moniker was coined in 2013 by my friend Bob Lang, a great options trader and the go-to technical analysis pro for Jim Cramer's Mad Money program. At the time, it was a handy way for him to describe the smoking hot momentum stocks that every serious trader had to be on top of. But they became so much more than that in terms of each company's impact on the economy. And yet, some serious investors don't like FANG and what it stands for. I'll explain with the short morning market note that I wrote to Zach's followers on Monday, September 11th. Tracking and trading the amazing Quad Squad FANG has been fun and very profitable ever since 2013. But there's been a backlash lately. You hear a lot of investment pros throw FANG around in disdain, as if it's a mere momentum fad. There's one big problem with that view, though. At least 3 of those companies are extremely transformative to the 21st century economy. That's why I own Facebook, for one. And then I have a sort of a subtitle in here: Own the Future by Owning the Sector with Teeth. And that's why I recommended long-term investors buy both Amazon and Google under $750 each in June of 2016. So what you are really hearing when a pro dismisses the market rally with, "Oh, it's just being led by the FANG stocks again," is, "I missed that money train." It's much easier to dismiss FANG if you missed it than to admit that these companies and their hundreds of tech satellites and partners are still creating the future of technology and commerce with their cloud, mobile, big data, and machine learning, artificial intelligence strategies. The bottom line, I say the current global technology expansion is a secular beast unto itself. Sure, it'll have hiccups and some demand limits will eventually hit semiconductor stocks, but for the next few quarters, don't be the investor who doesn't get the fortune-building opportunities in this crucial growth sector. So that was my short note on this week on FANG, and it has become this extended monologue here in Mind Over Money today. I called them extremely transformative companies and technologies, but another way of describing them is to use the favorite and powerful adjective of Peter Diamandis and Stephen Kotler: exponential. I've talked often here about the 2 books written by this dynamic duo, Bold and Abundance. And by exponential, they mean when something changes an industry or an economy or the world by factors and orders of magnitude, compounding. That's exponential impact. Here are the 6 exponential technologies that Diamandis and Kotler have been talking about in their books Abundance and Bold. Abundance was originally published in 2012, I believe, and updated in 2014. And Bold was a late 2015 book. So here are their 6 exponential technologies. 3D printing, which just revolutionizes and democratizes, as they like to say, manufacturing, because somebody can create a design on a computer and then build a prototype and test it without having to, create a whole, tool and die setup. So it really revolutionizes manufacturing, and it's being proven because big industry is using it. Boeing uses 3D printed parts in their airplanes. Also, because of the materials you can use, you can create, something lightweight and strong to your exact specifications. The second technology is infinite computing. And think of this as, supercomputers that can crunch a lot of data. IBM would be a workhorse there. Artificial intelligence is the third exponential technology. And one company that we talk a lot about there is NVIDIA with their parallel processing chips. And parallel processing is just having, hundreds of chips work simultaneously to collect, analyze data, and possibly learn, as opposed to just having, a few core processors. The fourth exponential technology is robotics. And regarding these first four, I wrote a special report in the spring of 2016 called Big Economic Disruption, where I was looking at the impacts of artificial intelligence and big data and robotics and trying to help investors figure out, well, what company should I buy here? And at the time, I was focused on how revolutionary the technologies are and a little concerned about the economic future for countries like China and India with this huge rising middle classes going through their own industrial revolutions, and yet manufacturing is changing so fast that there won't be this, their industrial revolution won't look anything like, Europe's or the U.S. because they're going to be skipping through sort of an industrial phase and going right to some of these exponential technologies, which in many ways, if you think about it, could provide a lot less jobs. And the study that I cited was from the Oxford Martin School and Citigroup, updated in 2015 or 2016, I believe, where they said, hey, you could see as much as 70 to 80% of jobs eliminated in China and India because of technologies like artificial intelligence and robotics. So that's a little bit scary for a population that could grow to 9 billion by 2050. So not knowing exactly which way to go, how to solve that huge problem, I said investors at least should be buying 4 stocks, no-brainers. I said you buy Amazon and Google, buy them below $750 in the summer of 2016, and that's where they were trading. They were under $750. I said buy them now if you're a long-term investor, and then also Microsoft and IBM, because of their dominance in cloud computing. This would naturally make them skilled and resourceful in areas like artificial intelligence and robotics. The last 2 exponential technologies that Diamandis and Kotler talk about are networks and sensors. So what they do is they group together this idea of the Internet of Things, where there could be chips embedded in just about everything. From the clothes you wear to the buildings you walk through, and all that information is getting stored and analyzed, and it sort of creates this second tier of global intelligence, which is a little bit scary, especially if you're worried about being monitored all the time. But that the potential, there's a lot of potential good there too, with networks and sensors everywhere in terms of capturing information and analyzing it. And then the last exponential technology they talk about is synthetic biology. I love talking about biotech, and we've talked here before about the bleeding edge, so to speak, of cancer research with immuno-oncology, teaching your body's immune system to fight your own cancer, and then the gene editing revolution, which is getting going. So we won't get too much into that here because it's pretty much over my head, but the future is wide open there, obviously. What medicine is going to be able to do just by leaps and bounds, that is definitely going to be exponential. Everything from artificial limbs to artificial eyes to who knows what we'll be able to do with organs and just amazing things. All right, now you probably laugh when you hear somebody say that Facebook is an exponential company changing the world. But by Bold's definition, the second book by Diamandis and Kotler, it is because of their 6 Ds. And the 6 Ds that they describe of exponential technologies are digitalization. So digitalization. I don't even know if that's a word, but I certainly can't even say it. Deception, disruption, demonetization, another new word, dematerialization, I'm sure that's a new word, and democratization. So, they're playing around with the Ds here, but they're making important points about how these technologies can change the world exponentially. And Facebook nails a couple of these with democratization, maybe demonetization and dematerialization, and obviously anything digital, right? So here's what I focus on. When you look at Facebook growing revenues from practically nothing to it's going to be over 40 billion this year, and it's mostly advertising, right? But what did they do? They created this platform not just for people to socialize, but also to create groups and find like-minded people and to maybe sell those like-minded people something, whether it's a T-shirt or a book or a course. And so it really created a revolution for the small business person and the medium-sized business too, to be able to target an audience with, affordable, almost precise advertising and get immediate feedback in a way that they never could, and to be able to sell all over the world, especially if you have a digital technology. So in that sense, Facebook does qualify as as creating exponential change. And believe me, they're not done. Kotler loves to point out, and I saw a video of him talking about Bold, I think he says, 40% of today's Fortune 500 companies will be gone in 10 years. Now, that's a pretty bold prediction. But if you think about it, how fast technology is changing, it's certainly possible that companies are going to be absorbed and transformed and forced out of business as new things happen. I mean, look what Amazon is doing to retail and how they're reinventing multiple categories. So Kotler wants to point out, hey, the entrepreneurs who win are those who can think exponentially. So we talked about how Facebook is exponential, and in another way, besides their reliance on advertising revenue, which who knows how long that's going to last. I've talked before about what they're up to in Building 8, and that's where they hired one of the engineers from DARPA, Regina Dugan, and they're thinking about a different sort of future than most people who are tooling around Facebook are thinking about. And that has to do with exponential technologies, whether it's going to be virtual reality, augmented reality, something to do with AI, and the way people communicate, the way they shop, the way they learn. Those will be the big transformations is in education, in commerce, and in communication. All right, take a little break here, and I will be back faster than you can spell exponentially dematerialized. Hey, welcome back. I want to get a little macro investing 101 here, and not just theory. I want to talk to investors who are really interested in this bull market, making new highs this week, just unbelievable. And people might be curious, hey, if I own a lot of stocks, should I be selling them here? People wonder, hey, is this the top? I don't want to get caught holding all these stocks. Is this going to be a repeat of 1999, 2000, or 2007, 2008? And why would I want to continue to own stocks, or why would I buy any new ones up here at this, what looks like a market peak? So I address this question all the time with people. It seems like I have to do it at least once a year during this long bull market. And the truth is that this is, this bull market is becoming the second longest ever, and the economic cycle itself underneath it, between recessions, is edging up into a long stander itself. So that's the thing, is how long can it go on? But what you have to remember is that bull markets do not die of old age. That's kind of an old saying, but it's true. They can defy the odds and any one of them can become the longest ever. And the way market cycles typically work is that, as long as the economy is expanding and interest rates are favorable, meaning they're not climbing too fast, and you don't want to see the 2-year Treasury note all of a sudden spike up because of inflation worries, and it's higher than the 10-year. That's called an inverted yield curve, and that usually sends stocks crashing as they anticipate a recession. Think about the economy overheating, inflation, excess capacity, and then when you go into recession, then stocks typically, on average, fall about 35%. The market itself will fall 35% on average into a recession. Now, it might only last 18 months, but it's painful for people who held onto their stocks and watched all their profits evaporate. So I wrote a piece just this past weekend called "The 5 Secrets of This Bull Market," and I wanted to help people think about the major issues, and not just the simple macro stuff like what are interest rates doing, or when is a recession coming, because I flat out say, hey, there's no recession on the horizon right now, and actually the one of the secrets that's working here for this bull market is that the economy is growing so slowly. It hovers around 2%. It never, once in a while it flirts with 3% GDP in a given quarter, but that's just kind of a snapback move, say after a slow winter quarter. So it's that steady nature of this economy growing around 2% and interest rates extremely low that has kept this bull market alive for so long and probably will continue to do so for another 3 years. So, in this environment, do you say that this is the top of the stock market? I say no way. We're making record highs here in many stocks, sectors, industries, and I think we'll continue to do so for the next year. So of the 5 secrets of this bull market that I talked about, let me highlight some that connect into the exponential technologies we're talking about and the secret meaning of FANG. Secret number 3 was the tech cycle is bigger than the fast money. This one is simple. Money doesn't leave the markets, it just moves around, often at light speed, especially when interest rates are near 1%. Especially in an expanding global economy when equities, stocks, still offer the best risk-reward compared to other asset classes. But the old rules about sector rotation don't apply anymore as the economic cycle is not driven as strongly by the boom and bust nature of industrial manufacturing and real estate. Today, long-term investors are focused on the transformational technologies of the cloud, mobile, e-commerce, automation and machine learning, and biotech breakthroughs in cancer research, as Gilead Sciences just affirmed with their $12 billion purchase of Kite Pharma, which was last week. So it's easy to get fooled by the risk-on, risk-off movement of stocks by hedge funds and algo trading and forget that these long-term technology trends will be driving economic growth for decades, even if a recession unfolds before 2020. And I put in parentheses, doubtful now. So the other themes that I talked about were, what institutional investors do, the big money. When you think about pension funds, mutual funds, insurance companies, hedge funds, endowments, this is what we call institutional investors. And together, these institutions hold tens of trillions of dollars. And their job is to buy stocks. Their job is not to sit in cash. Some of them will have to buy bonds, but many trillions of these dollars are earmarked for one thing, and that's for long-term growth in equities. So these fund managers, they have to be heads down picking stocks because it's their job to buy stocks, and they're competing against the benchmark, which is the S&P 500. So if the S&P 500 goes up, they better be performing along with it and beating some of their peers at least so they can keep their job. So, that's one thing to keep in mind is that tens of trillions of dollars are committed to be invested in the stock market. And if there's no recession on the horizon, that money's going to stay there, and new money coming in is going to keep buying stocks. So one thing I like to do is follow some of these big fund managers. In my secret number 4, it's called, in a market of stocks, winning equals following the big money. What drives stocks higher? 2 words, earnings growth. Investors buy companies or shares to capture a future stream of growing cash flows at some discount today. Earnings matter as the primary motivation, but really it's the actual buying of a stock that is required to move its price higher as demand outstrips supply. And who does that kind of buying where demand outstrips supply? The institutions that we just talked about. And they don't care about the PE ratio of the S&P 500. They are focused on the long-term potential of their investment theses in given companies and industries. And my shorthand for that is they're heads down picking stocks. They're not, as long as there's no recession on the horizon, they're going, I like this company. NVIDIA is another good one. Some of these, I talked about disdain for the FANG stocks by people who missed it. Talk about NVIDIA, the maker of these parallel processing artificial intelligence chips. And this stock has so many haters among institutions who think that it's only worth $100 or even $75. And the stock is trading at $160. And buyers keep coming in. It's probably making new highs today. I don't even know if it's back above 170. But it's price earnings and price to sales ratios. They're high. So on a valuation basis, the stock is expensive. It doesn't have the sales necessarily to justify a $70 billion market cap. But it's because of the future growth that they expect here. I don't know if anybody knows this, but NVIDIA, their chips are being bought by the guys doing the cryptocurrency mining. So for Bitcoin and Ethereum, you need NVIDIA chips to run these machines that are sucking electricity and mining for Bitcoin and Ethereum. It's crazy stuff, but also NVIDIA chips, they go in the game graphics and then in the supercomputers. So when a university wants to build a supercomputer and have it do some kind of AI work, they need NVIDIA chips for that parallel processing. Let me talk about some other stocks here that people have doubted. So, I follow what I call the whales of institutional investing, and just because I like to see what they're buying and their time frame is so long, they're looking out 2, 3, 5 years. So I say that in this article, I followed many of the best hedge fund managers in the world for years, and sometimes they follow me. Like when David Tepper of Appaloosa, Dan Loeb of Third Point, and Andreas Halverson of Viking Global all started new positions in Alibaba in the second quarter of this year, which means they were paying between, 145 and 160, and we were buyers of it back at 100 in January and February. So that was nice to see. So that's sort of my macro theme on investing cycles, and to answer the question that people have, hey, is this going to be a market top? And this is how I answer it. No, because these exponential technologies are driving new kinds of growth and fueling investment of all kinds, globally, and that just keeps the economy humming. So I want to go back to D. Maness and Kotler right now and read you a really cool section from their book, Abundance. I think I read from Abundance last time, but this section was so fun I have to do it again. This is I'm looking at their paperback here of Abundance, page 148. The World is My Coffee Shop. In his excellent book, Where Good Ideas Come From, The Natural History of Innovation, author Stephen Johnson explores the impact of coffee houses on the Enlightenment culture of the 18th century. It's no accident, he says, that the age of reason accompanies the rise of caffeinated beverages. There are two main drivers at work here. The first is that before the discovery of coffee, much of the world was intoxicated much of the day. This was mostly a health issue. Water was too polluted to drink, so beer was the beverage of choice. In his New Yorker essay, Java Man, Malcolm Gladwell explains it this way. Until the 18th century, it must be remembered, many Westerners drank beer almost continuously, even beginning their day with something called beer soup. Now they begin each day with a strong cup of coffee. One way to explain the Industrial Revolution is as the inevitable consequence of a world where people suddenly preferred being jittery to being drunk. And that was Malcolm Gladwell in his New Yorker essay, Java Man. And D. Maness and Kotler continue. But equally important to the Enlightenment was the coffee house as a hub for information sharing. These new establishments drew people from all walks of life. Suddenly, the rabble could party alongside the royals, and this allowed all sorts of novel notions to begin to meet and mingle and, as Matt Ridley says, have sex. In his book, London Coffee Houses, Bryant Lillywhite explains it this way. The London coffee houses provided a gathering place where, for a penny admission charge, any man who was reasonably dressed could smoke his long clay pipe, sip a dish of coffee, read the newsletters of the day, or enter into conversations with other patrons. At the period when journalism was in its infancy and the postal system was unorganized and irregular, the coffee house provided a center of communication for news and information. Naturally, this dissemination of news led to the dissemination of ideas, and the coffee house served as a forum for their discussion. And they go on in this section talking about how the growth of cities in itself creates innovation and new ideas and thus wealth. Santa Fe Institute physicist Geoffrey West found that when a city's population doubles, there is a 15% increase in income, wealth, and innovation. And he measured this innovation by counting the number of new patents. They go on here, talking about, Kotler and D. Maness talk about the billions, trying to rise up, right? They have a phrase for it. What are they? The rising billion. They talk about. Yeah, that's actually the name of this chapter, is the rising billion. And it's an important theme for me too, as a global investor looking at emerging markets like China and India, with potentially 2 billion people trying to get into the middle class and have lifestyles just like the West. They want to have homes, cars, send their kids to college, nice clothes. So, and that urge is unstoppable and insatiable. So when they think about, what's the potential here, how do we take care of, the rising billion, and how do they get access to the global economy? This is one thing that they're really interested in. So I continue here in this section. The upside of this surge is immeasurable. Never before in history has the global marketplace touched so many consumers and provided access to so many producers. The opportunities for collaborative thinking are also growing exponentially. And since progress is cumulative, the resulting innovations are going to grow exponentially as well. For the first time ever, the rising billion will have the remarkable power to identify, solve, and implement their own abundant solutions. And thanks to the net, those solutions aren't going to stay balkanized in the developing world. It's a great section. You should definitely read all of Abundance, but that one in particular. So it began with a little history of the European coffee shop creating Enlightenment culture, where ideas could have sex, and ended up with a hopeful message about the rising billion. So what I'm keep asking is, do we have reason to be so optimistic about this many people bootstrapping themselves out of poverty? That was my theme in my report from last year, Big Economic Disruption, when we had to consider, is this dire prediction of potentially 70% of jobs being eliminated in the BRIC countries due to automation, is that a real concern? I think the chief economist from Vanguard just picked up on those dire predictions last week and wrote a piece about it, about how, the dark side of automation, so to speak. And it brings in why somebody like Mark Zuckerberg of Facebook would talk about this concept of UBI, universal basic income. Like somehow we need to pay everybody a universal basic income because there's not going to be any work for them. That's some wild stuff. In my May episode of Mind Over Money, I did a piece called May 9th, as a matter of fact, What to Do Before the Machines Take Over. And that was sort of I don't want to say dark, but it wasn't that optimistic a piece, because I was using, talking about all this stuff and the book by Yuval Noah Harari, Homo Deus, where he said one possible future here, the way we're accelerating with exponential technology, is that the wealthy are going to be able to afford all kinds of solutions, and the poor, of which there will be more without work or universal basic income, will not have such great lives. So that's Harari's book, Homo Deus. But I did try to end that episode on an optimistic note, and I think we have to be optimists, and here's why. Because I went through this in the early 90s. I was sort of a left-wing, tree-hugging radical socialist, and I woke up from that nightmare and realized that, hey, technology is here to stay because it's in our nature. We were born to create. Ingenuity and innovation are in our DNA. So you can never stop people creating new technologies that might create new problems. So we can't predict everything, and we also can't stop it from unfolding. We learn to co-create with the complexity, with the chaos, and with the unwanted results. And it's almost like when you wake up in the morning, if you sat and worried about all the things that could go wrong in your day, and your commute, when you got to work, whatever, you wouldn't even leave the house. But, you take your chances and you're like, okay, I'm getting in my car. I know that most people die in car accidents, but I'm optimistic that I'm going to get through this, be as safe as I can. And you go through your day, get to work, and you deal with whatever comes up. And it's that sort of natural optimism that makes our lives better. And so if we sat around and worried about technology creating all the new problems it might, whether it's pollution or some new super drug or weapon, we wouldn't get anything done. And so to look at the future and be concerned that, hey, automation is going to change the world so much that billions of people won't even have work, hey, we really can't worry about that right now. And if you read the books by Diamandis and Kotler, Abundance and Bold, you actually stay optimistic that we're going to figure this out. And that's why I definitely latched onto these books again. All right. It's been another great session, and I hope to remain as optimistic as we all should. Thanks for joining me.